Happy Infrastructure Week, Comey Day, China Joe Gagnon Fest at the Institute, and various other occasions. I'm Adam Posen, president of the Peterson Institute for International Economics, and it's my pleasure to welcome our distinguished friends and guests here in person and our many friends online, ideally a large number of whom today, and we hope always in China, but as well around the world. We are gathered here today in joint effort with our friends from the China Finance 40 Forum to talk about some work we've done together on U.S.-China economic relations in what we're calling the new era of globalization, the perhaps less automatic, less hospitable, but thank God not yet reversed era of globalization that we all now face. And as all of you are well aware, we had the early harvest, as it was called, coming out of very intensive U.S.-China bilateral government discussions as part of the 100-day process agreed by President Xi and President Trump at Mar-a-Lago summit. I don't think I am offering any out-of-the-mainstream opinions or letting know any secrets by saying this was a lot of fuss for very little deliverables, in which case, frankly, I don't blame the participants, at least on the Chinese side. The goal, and I think rightly, was to suggest that there could be an ongoing constructive process and demonstrate that it would happen. And the Trump administration representative's goal seemed to be to demonstrate, as they did to no effect with Carrier and various other things, that if you announce something with a company's name on it, people like it. There are, however, some real issues in the U.S.-China economic relationship, as well as very large real gains to be had by better cooperation. And for that reason, we brought together a wealth of our authors and respected colleagues from China to offer this new report, which is available online on PIIE website as well as CF40 website, U.S.-China Cooperation in a Changing Global Economy. Myself and Dr. Jiming Ha, who's with us today, we're the editors, and we have the collective wisdom of many of our colleagues. And we're going to give you a set of highlights from it today. One word of explanation, administratively or institutionally, and then on to the substance, and I will introduce the speakers. I hope you're all familiar with the Peterson Institute. We are very proud over the last 5 years to have massively strengthened our relationships and I believe, frankly, our reputation and impact in the People's Republic of China. We always had Nick Lardy, or for a long time now have had Nick Lardy, America's leading expert on the Chinese economy, but we have now engaged with a whole range of people in the Chinese government and top-level Chinese academics and business people in a way that we had not previously. And in particular, we have been able to do that in part through our partnership with the China Finance Forum 40, which is a network of economists from academia, from government, from business in China, and has been in recent years moving towards becoming an actual think tank as well as a network, if you will, from being an NBER to being more of a PIIE. They have been a great partner to us, and each year we've done more and more collaborative work around our annual trip to China, which they help us make happen. And this year was culminated in this report. And we admire CF40 as, frankly, one of the most, if not the most, independent non-government think tank in China, at least on economics. Turning back to substance, it is very easy to get lost in counting heads of cattle, or for that matter, even very serious things like opening up China's payment systems to fair competition in line with WTO rulings. These are important matters. It is also very easy to be overwhelmed by the seemingly, to many of us, unnecessary conflicts that are being created, as with the U.S. withdrawal from the Paris Accords on climate, where the U.S. had nothing binding it and would not have had an effect if they had just simply stayed in. In a piece of irony, many of you saw that the chargé d'affaires at the U.S. Embassy in Beijing resigned before delivering the actual communique announcing U.S.'s withdrawal. That same long-standing Foreign Service officer was actually a keynote speaker at our joint conference with CF40 in Beijing last month, in which he carried a lot of water for the Trump administration, arguing very vociferously for breaking down Chinese trade barriers. So much going on. Our hope with this effort is to try to get a little beyond and above the day-to-day, the rush to judgment of the 100 days for deliverables, the conflicts that pop up of their own accord. It's to think about what are the big issues: exchange rate relations, bilateral investment, including the possibility of a treaty, China and the U.S. interests in each other's fiscal stability and financial flows, how China should use and think about reform in terms of its relations with the U.S., how the U.S. has to think about its own domestic demands for counterproductive, frankly, trade policies. We are trying to focus on the places where the U.S. and China can constructively still work together, and we are hopeful that we will contribute to that returning, if not growing, in coming years. So we will have 4 speakers today. I'm delighted to welcome to the Institute for the first time Dr. Jiming Ha, who was most recently managing director of Goldman Sachs based in Hong Kong, where he was from 2010 till last month. He was previously chief economist at China International Capital Corporation and a senior economist at the IMF, where some of our friends already knew him. He, in addition to authoring a chapter in the book, he and I together co-authored the overview, which he will be presenting in a moment. Following Dr. Jiming will be our colleague Joseph Gagnon, who, as I've jokingly said, is everywhere this week at the Institute. On Tuesday, we released his new book with Fred Bergston on currency manipulation. Do you have a copy? Can you hold it up? Buy it. Joe, of course, had a distinguished career at the Federal Reserve at very senior levels, including playing a key role in the creation of QE1, which everybody loves, even if they don't like QE2 and 3. He will be followed by Chad Bown, star of stage and screen. Chad joined us just over a year ago from the World Bank, where he'd been conducting very first-rate research on international trade policy, and recently prior serving as senior economist for international trade and investment in the White House on the Council of Economic Advisors staff. Chad is, the reason I joke about stage and screen is he has had the fastest pickup in press coverage and Twitter feed and fanboys of any fellow we've hired, and deserves it. He has been there with some great work on what's going on in trade, and he will be sharing some of that specifically with regard to issues like China market economy status and steel right now. Finally, batting cleanup, if we're still allowed baseball analogies, is my longtime colleague Jeffrey Schott, who's been a senior fellow at the Institute since 1983. More importantly, he's one of the world's leading experts on the practice of international trade negotiations, on Asian trade integration, including the role he played in development of the Korea-US Free Trade Agreement. He's the co-author or editor of multiple books, including for us, notably, one of the leaders of our work on Trans-Pacific Partnership, an idea whose time will come again. So let me now turn the stage over to Dr. Jiming.
Thank you, Adam, for the nice introduction and for, for all you did for this study, the joint study, and this event. It's a great honor to be here on behalf of CF40, which I helped funded together with other 7 economists in 2009, when I was the chief economist with China International Capital Corporation in Beijing. I treat DC as my second hometown, as I lived here for 11 years when I was with the IMF. I just retired from Goldman Sachs. I'm not affiliated with any institutions at this moment. So today I'm here just to deliver the message, the key takeaways that we got from this joint study between CF40 and PIIE. Here, I think 5 key messages I wish to deliver today. The first is on trade, trade imbalance between the US and China. Second is bilateral investment. China's investment in the US is rising, and US investment in China was already quite sizable in the past 30 years. So it is probably the time to talk about going forward what kind of bilateral investment will be beneficiary to both sides. The third issue is renminbi exchange rate. Is China manipulating the currency, or it is actually following the market force in setting the exchange rate? The third message, or the findings that we produced in this report, is how the US new administration's policy, economic policies in particular, would impact China. And we sort of conclude that China's economy can manage the impact of Trump's policies. And we can talk a few aspects of the policies. The final message which I wish to deliver is we both agree that China should press ahead with structural reforms and to avoid conflicts with the US. Now let me briefly elaborate the 5 takeaways. First, on trade. We think that the structural factors are behind the trade imbalances between the two countries. It's probably not exchange rate or some other factors. It's mainly the structural factors. In fact, yes, China contributed about half of US deficit in good trade, in 2016. Of course, if you take into account the intermediate goods, or you calculate value-added terms, the contribution is 1/3, still quite sizable. But China is a very high saving, China's households have a very high savings propensity. High savings rate in China made it a current account surplus country, unless investment growth could be extremely fast to fully absorb investment, domestic savings. But that is probably either impossible or unhealthy. In fact, rapid investment growth over the past decades already led to overcapacity and debt problems in China, which could potentially sow seeds for financial difficulties going forward. Therefore, it is critically important to promote China's consumption in order to reduce savings. In this regard, I think there are some good news. First, the recent abolishment of the one-child policy and measures aimed at reducing income inequality, as well as improved social safety net, would help China to reduce its savings rate. And more importantly, China's savings rate is projected to fall, probably at a very significant pace going forward alongside population aging. That is a phenomenon that we observed in the 1990s Japan. Secondly, the second message is on bilateral investment. And it goes without saying, China and the US should benefit from enhanced bilateral investment. The issue is fairness. I think the high complementarity of the two economies entails or suggests that investments, cross-border investment between China and the US should benefit both countries that are the largest in the 2 largest economies in the world. And it will also benefit the world economy. Here I want to particularly highlight the service sector in China. You know, China opened up its economy in the 80s, starting with the manufacturing sector. So productivity growth in the manufacturing sector was extremely fast in the past decades. However, the service sector fell behind. And it's probably the time for China to further open the service sector to foreign investors. There are a number of service sectors in China that are still either monopolized or highly dominated by the state. So it will be important for China's own transformation to a consumer-led economy and to improve its productivity to open the service sector. At the same time, Chinese enterprises also hope that the Committee on Foreign Investment in the US could reduce various discriminatory barriers in the name of national security. The third message is probably a very hot issue, renminbi exchange rate. We think that China is not manipulating yuan to gain trade advantages. Claims that China manipulates currency to promote exports is clearly outdated. In fact, measures such as capital controls and the recent fine-tuning of the setting of daily fixing suggests that China is trying to prevent the renminbi from a disorderly depreciation against the dollar, not appreciation. Furthermore, China does not meet the US Treasury's criteria for currency manipulator. For example, China's foreign exchange reserve is on the decline, not rise. Here, I would like to also offer my personal view on China's exchange rate. While perhaps effective or even desirable in the short term, capital controls is not a long-term solution to exchange rates or capital flow issues. I think China should continue to reform the exchange rate policy by letting the market play a decisive role, regardless of the direction of the exchange rate movements. That is to say 10 years ago, when the renminbi should appreciate, it is probably not wise to constrain the size of appreciation. Today, probably the renminbi is under pressure to depreciate. It is equally unwise to constrain the size of depreciation. Appreciating currency or even maintaining the exchange rate, bilateral exchange rate with the dollar, actually would sacrifice China's economy. So that's the third issue. And the fourth is how China would manage possible impact from Trump's new economic policies. The first policy we studied in the report is the US tax policy. And we think that the US tax cuts could have a very good demonstrative effect on China because tax burdens are much higher in the latter. One of the factors behind the rapid surge in China's ODI into the US is tax consideration. The high tax burdens in China reflect not only the fees and charges on top of the statutory tax, but also very high land prices and still skyrocketing land prices, which serve as a de facto tax for local government revenues. Skyrocketing land prices push up property prices, posing considerable risks to the Chinese economy in general and financial system in particular. So I think there are at least two kinds of fiscal reforms that China should implement. One is imposing property tax to constrain property price inflation. And the second is to streamline local and central government fiscal relationship. You know, in China, there's a serious revenue and expenditure mismatch between the center and the local governments. Local governments receive about half of total revenue, but are responsible for 3/4 of expenditures. Therefore, they always try to figure out ways to get revenue. One way of getting it is through land sale. So they actually do not have the incentive to reduce land price or property price. And the second is to establish the so-called local government financing vehicles or find other very intransparent ways of borrowing money from the economy that not only increased the overall indebtedness of the government, but also made the debt structure very intransparent. And the second economic policy we're considering is a possible increase in US infrastructure investment. And we think that China should potentially benefit an increased infrastructure investment in the US, given China's high level of expertise in infrastructure development, both home and abroad, and also funding availability. The third is financial deregulation in the US. Despite the prospect of the US simplifying or relaxing some provisions of the Dodd-Frank Act, China instead should strengthen its financial regulation and supervision. Because in China, financial institutions are increasingly engaging in cross-market, cross-sector activities, which poses challenge to regulators. The lack of information sharing and coordination between various financial regulators during the market turmoil in 2015 is a case in point. But the good news is now discussion has been ongoing about reforming the regulatory framework in China. Currently, the 4 financial regulators, namely PBOC, CBRC, CSRC, and CIRC, are working together to establish a set of unified rules for asset management products, which is a step toward high level of policy coordination and concerted efforts to strengthen financial regulations. The fourth measure is probably the outcome of the economic policies from the new administration. That is, given that the US economy is already recovering for the 9th year in a row, and wage pressure is on the rise, unemployment rate is already quite low, further fiscal stimulus or deregulation could lead to high inflation, which will inevitably lead to response by the Fed on the monetary policy front. So a interest rate hike or monetary policy normalization in the US could have spillover effect on China, which has indeed already been withdrawing monetary stimulus in the recent period by raising short-term interest rates in China. Because the economy is doing, at least for now, is still doing pretty strong 6.5 to 7% growth. And also property prices increased a lot in the past 2 years. But the synchronization of monetary policy from China will also prevent the yuan from depreciating too fast against the dollar. This is apparently consistent with the understanding of the currency issues of the leaders in the two countries. I think that would be the understanding for now. The fifth message, or the final message I wish to deliver, is China needs to speed up reform and further open up the economy, particularly the service sector, to avoid conflict with the US. One of the key reforms that I want to mention here is reforms of the state-owned enterprises. Market-oriented SOE reforms. Here I want to emphasize, it's not just SOE reforms, it's market-oriented SOE reforms would help reduce China's long-term economic vulnerability, also improve China's prospects to be recognized globally as a market economy. A number of key sectors in the Chinese economy, such as finance, telecom, healthcare, among others, are still dominated by state-owned enterprises. And this actually does not send a very good image to the international community when Chinese companies go abroad or Chinese companies compete or operate domestically. We know that the Chinese government also, from time to time, subsidizes enterprises and provide concessional loans in dock. Therefore, accelerating reform of state-owned enterprises can ease accusations of unfair trade by all China's trading partners. That will be a very positive move for China to take. In the interest of time, I think I'll better stop here and give the floor to other speakers. Thank you.
Here we go. Okay. Thank you. This slide here is basically my presentation in a nutshell. China has long focused on a stable exchange rate, in particular against the US dollar. And now it's been turning to focusing a bit more on a trade-weighted exchange rate, which makes some sense. But I want to argue that, in fact, it's really trade balances, and I'm going to refer to the current account and the trade balance as the same thing. That's one broad measure of the trade balance. That those are more important, really, economically than swings in exchange rates, and they make more sense. Foreign exchange intervention, exchange rate policy, should really look at that more even than the exchange rate. And that this should be done in a framework that leaves monetary and fiscal policy free to stabilize the domestic economy. So we see that the solid line here is the bilateral dollar exchange rate of China, and it's plotted at inverse scale, so an increase is an appreciation. You see, up until a couple of years ago, long periods of very stable, perfectly flat almost, exchange rates broken up by periods of steady rises. But this all changed a couple of years ago. And I think at that point, what happened is there was a shift to a more focus on a multilateral exchange rate. I've shown here the dashed line is the JP Morgan trade-weighted real effective exchange rate. You could use other measures. It isn't that important. What you see is that stabilizing the dollar rate did not at all stabilize the real effective rate, and that's what really matters more. So in some sense, stability is really subjective. But I think what happened about 2 years ago is there's a bit more focus on the dashed line. And although it's not perfectly stable either, the depreciation in 2016 could be seen as maybe a reversal of too much appreciation a year earlier. There's still a clear upward trend in the dashed line, which is important because as long as China has more rapid productivity growth than the rest of the world, it's going to need some real appreciation. Maybe not as much as in the past, maybe it could be a slower rate, but it should be not a trend that's not being reversed, even if it's being slowed. And so I think this is important to keep in mind. All right. This clicker is, there we go. But the other thing to note is that the current account imbalances are widening again. And in particular, imbalances of the major economies peaked in 2006 to 2008. They narrowed in the recession in 2009, but they remain moderately large for 5 years in a row, and they now seem to be widening again. This time, China's not the main driver. Europe and the US are more important. But this is an indication that the G20, which had made this an important thing to further narrow the imbalances as part of their sustainable and balanced growth, never really fully succeeded, and now, in fact, it's going into reverse. So I think this may become a more important issue again. I hope not too much, but we'll see. The key point that I would say is that imbalances do matter. They're more important than exchange rate volatility. I mean, the reason we care about stabilizing exchange rates really is mostly because we care about people being able to buy and sell in foreign markets. And so the trade balance is really a better indicator of difficulties that might arise there. Also, imbalances are associated with borrowing and lending across borders, and we know financial markets sometimes get it wrong and send too much capital one place or another, requiring later painful adjustments. Also, at least in the US and maybe some other countries, it's really the imbalances that drive protectionist pressures. Foreign exchange intervention is a tool that can help here. My work suggests that, and other work at the IMF that works looking at the effect of intervention on exchange rates, which then affect imbalances, also suggests that that should be the case. In my book, which Adam mentioned, with Fred Bergston, Currency Conflict and Trade Policy, talks about these issues at some detail. One thing that's in the book, which isn't the main point of the book, but it is in there, is a discussion of whether something like the reference rate strategy that my former colleague John Williamson promoted might be a good idea. And let me preface this by saying that this is not, the earlier proposals by people here talked about limits on what exchange rates could do. This is not any kind of limit on what exchange rates can do. This is not even a limit on what current account imbalances can do. It's just a framework for thinking about how to do intervention. What should intervention focus on without any commitments about either the exchange rate or the trade balance. But the point would be that intervention should be targeted towards the current account imbalances and should lean against the wind. And in particular, if the balance gets too big, say more than 3% of GDP, you should definitely not continue to intervene to support or enlarge that imbalance. That's the minimum standard, do no harm. A more stronger version of the reference rate would actually say maybe you should be encouraged to do the reverse. You should actually be encouraged to sell foreign currency to try to lean against that wind and push back towards zero. Again, even without any absolute ironclad commitment about what you could achieve, but it's a framework for communicating to markets about what your philosophy is about why you intervene. And it would help to damp somewhat unsustainable imbalances. What would that mean for China? Well, I've plotted here China's current account as a percent of GDP over the past, and I put in the proposed target limits of 3% above and below zero. Now, China didn't have a deficit at all in this period, but it did sometimes have a surplus above the 3%, and all the weakest version of this reference rate would have said China should not have continued to buy purchases. It should have let the renminbi appreciate more, as Dr. Ha said just now, and that would have damped some of that rise in the current account. Now we are at a point in 2016 where China's current account is below 3, so it wouldn't actually impose any restrictions. But China is actually going beyond that. China actually is actively taking, in practice, resisting depreciation pressures on their currency by selling foreign exchange. So China is actually the only one of the major reserve currencies that's really actively following a stronger version of the reference rate strategy now and resisting depreciation when they have a surplus, which is good, which is what we'd want. You could argue that maybe the other reserve currencies should also join in. Japan and the euro area now have surpluses just above 3. It's a point at which they would not be allowed to buy more foreign exchange, and they aren't, so that's fine. But they could even be encouraged perhaps to sell a bit, especially Japan has a lot. And similarly, you could argue for the US and UK, which are flirting with 3% on the low end, maybe they should be considering buying. This is a framework that all countries could hopefully agree on for more harmony. One key point is that if you're going to do the selling part, you need to have a minimum adequate amount, and does China have enough? Well, my view is that China has plenty of reserves above the standard benchmarks of reserve adequacy, as I'll show you. There is a new reserve metric IMF has proposed, which gives, in my view, a much too large of a weight to the money supply. And on this metric, China has enough, but not a huge excess. My own view is that For a floating exchange rate currency, that's a reserve currency, that's not an appropriate metric. But the other ones, on the other metrics, they have plenty. Here we see the solid line is China's foreign exchange reserves. And as you can see, they've been coming down in the last 2 years. That's the proactive Chinese policy of resisting depreciation, which makes sense in this framework. The dashed line is China's short-term foreign currency debt, which peaked at about $1 trillion and is now falling. And the red sort of, dotted line is 3 months worth of imports. As you can see, China's reserves are way above both of these conventional measures of adequacy, so there's plenty of room. Okay, so what is the policy prescription then? It's just that you should resist depreciation of the real exchange rate as long as your current account's above zero and your reserves are above the benchmark minimum. But if you're selling reserves and eventually you start getting closer to $1 trillion, you might start doing less of that and allow some further depreciation. On the other side, once appreciation pressures resume, which eventually at some point they will, then you should not resist right now because the current account's above zero and reserves are more than adequate. But if you did get below to a negative current account, then you could resist. The key point is that in China, at least, the long-term trend is still upward, at least a little bit. This leaves monetary and fiscal policy fully free to do domestic stabilization. Capital account liberalization, I don't think, is an urgent priority, but it's a long-run goal. The reference rate strategy works better with more closed markets, but it can work somewhat even with open markets, according to the best estimates. Okay, so one quick digression. There's a key macro risk, which was alluded to. In China, the progress on domestic rebalancing is too slow. Saving and investment are too high, raising financial risks. What we really want is more consumption and less investment. Expanding the social safety net would be a powerful support. Research at the IMF and my own research shows that a deficit-neutral switch of spending into social safety programs, either financed by cutting other spending or raising taxes, but no deficit, greatly expands consumption by 50 cents to $1 for every dollar spent. That's an enormous effect. The IMF research confirms it. It seems like that kind of policy is a win-win for China internally and for the world. And then finally, to conclude, China values stability. Stabilizing current account balances, I believe, is more important than stabilizing exchange rate. It's what really matters. And intervention policy should be used while keeping monetary and fiscal policy free to stabilize domestic inflation and employment. I think there'd be no hard target for the exchange rate or the current account. I think there are some people in China who would actually like to go in a slightly different direction, which is to not intervene at all ever, up or down, and have a completely free exchange rate. I could understand the attractiveness of that, but I'm not sure that the world is quite ready for that yet. It seems to me what China's actually doing is better, which is to stabilize and prevent imbalances from widening. And I'll leave it there.
So thank you for the opportunity to be here today. I am going to talk about conflict. So one of the current ones ongoing between the United States and China is over steel. And so what I'm going to do is to use steel as really kind of a lens through which to understand a lot of the fundamental underlying areas of friction and tension that still exist even before the Trump administration came into office, but mainly between the US and China. Okay, and along the way, what I'm going to do is to touch on a number of different topics in trade policy. So we'll get into some of the key fundamental underlying concerns that the two sides have in terms of the use of policies like anti-dumping, countervailing duties, the treatment of China as a non-market economy in the global trading system, not only by the United States, but by the European Union and others as well, how this is getting resolved, potentially through WTO dispute settlement, but really I think this is a bigger political issue. And up until that point in my talk, this is sort of the state of the world before the Trump administration came in, and this was really what they had inherited, and this was a set of issues and conflicts that were going to have to be dealt with regardless of who was sitting in the Oval Office right now. But since they have come along, they have introduced a number of new complexities into the mix through a number of new trade policy tools that they have actively taken up. And I'm going to try to get into some of those as well to show how that, in many respects, is actually going to complicate some of the underlying issues involving the United States and China, and make their bilateral issues arguably potentially spill over to the global trading system as well. But let's start with steel. So this is just a chart showing basically what's happened in the capacity of steel production globally between 2005 and 2015. And during this time period, global capacity in steel production increased by 80%, but it was very unevenly distributed. So across the OECD, the rich countries, their capacity expanded by only a little, by 13%. By non-China, non-OECDs, so the Brazils, Indias, Russias of the world, their capacity expanded by 74%. But a huge chunk of the capacity was China. Their growth in steel capacity was 176% over this time period. And this is really what the underlying issue in steel is. They now basically make up, having gone from a third of world capacity in 2005 to about half of world capacity now. And in terms of production, it's probably even a bit more dramatic. So between 2005 and 2015, production by China expanded by 126%. And basically for the rest of the world, it was flat. And so a little bit of this is 2015 was a little bit of a down year in terms of steel production. But for all of the countries out there, essentially no increase in production. So, all of it, in some sense, is coming from China. Obviously, there's distributional within the non-China set there. You do have some countries growing, some countries shrinking, but China is a big part of that story. Now, just to put in one chart, I think what the fundamental underlying concern with all of this is, the chart on the left shows the ratio of a country's exports of steel to its production. And China is the blue line very near the bottom in the chart on the left. And so I've split the chart up into countries that are the big exporters of steel. Those are the guys on the left. So this is China, Korea, Japan. India is also on there as well, and smaller steel exporters are on the right. And so amongst the major steel exporting countries, and this is countries that export 13% or more is my cutoff of the world's steel, China actually exports a very small share of its total production. So as late as 2009, it was only exporting about 4% of its total production. Whereas you look at countries like Korea and Japan, they're exporting in the neighborhood of 35 to 40%, right? Over the last 6 or 7 years, China has gone from exporting 4% of production, 7% of production, to most recently, they're now exporting 14, 15% of production. And the concern, obviously, is as the Chinese domestic economy slows and their growth slows down and they need less and less steel domestically, that they're going to increasingly export more and more. And what the implications of that are for the global economy. And if they got to levels of the Japans and the Koreas of the world, the 35 to 40% of production actually exporting that, what that would mean for the rest of the world's steel industry, right? So that sort of lays out, I think, pretty starkly what the concern of the rest of the world is when they talk about China's overcapacity in steel and the underlying question: are they going to scale it back? Now that their growth is slowing, they don't need it domestically. Are they going to reduce their capacity, or are they going to just try to export their way out of it? So before the Trump administration came into office, there was a major issue involving the U.S. and China called China's non-market economy status. We haven't heard too much about that, but it's worth reviewing what that basically is in this storyline, and that's what this chart shows you here. So the light blue line in this chart is essentially the share of U.S. imports from China that are sitting under or affected by anti-dumping, right? So China's non-market economy status at the WTO, China comes into the WTO in 2001, and the WTO allows existing members to treat China differently than everybody else if you're conducting an anti-dumping investigation. So you're allowed to use these special surrogate country techniques, which makes it more likely you're going to be able to find evidence of the dumping and actually impose higher import restrictions. So all countries had access to this. What did it actually mean? Well, over time, the United States, now by the end of 2015, about 7% of potential imports coming in from China are sitting under these kinds of import restrictions. But that being said, we all know that China's export growth to the United States and the world still did relatively stupendously during that period. So it was sort of a trade-off. Yes, China accepted non-market economy status, made it easier for countries to use anti-dumping against it, but the trade-off was lots and lots of exports that weren't being affected by anti-dumping. The other thing I want to draw your attention to in this chart is the red line. And so the red line represents the share of U.S. imports from China sitting under a different policy, which is the U.S.'s countervailing duty policy, the anti-subsidy policy. And back in 2006, 2007, the United States first started using this for the first time. And what I would argue is if the United States and other countries were to suddenly have to give up China's non-market economy status and have to treat them like a market economy in anti-dumping cases, provided they were still able to use countervailing duties against China, the red line there, we wouldn't expect all that much to actually happen necessarily economically, because as you can see, by 2015 it's even higher now. Most of the imports that are sitting under anti-dumping import restrictions are also sitting under countervailing duty restrictions at the same time. I'm going to skip through this chart just to get to my conclusions and what's different about the Trump administration. So this issue of China's market economy status, which we really haven't heard anything about since December. It's now, at the WTO, potentially could be a long-term dispute to get litigated over the next few years. That's to remind me to stop talking, but I'm not done yet. That was all out there and ongoing, right? But what's different with the Trump administration that we have to think about, especially in the context of steel, is some completely new policy tools that they're introducing and what that could potentially mean, right? And so the middle one, the thing that I have up there on the list is this Section 32 case. This investigation into whether imports of steel are a threat to national security. So that investigation is taking place right now. This is a rarely used law. The last time we saw one of these cases was back in 2001. And this is very, very differently than anti-dumping, countervailing duties, or even the global safeguard, the Section 201 policy, right? It's a much less transparent process, how the investigation works. And the discretion that the president has in ultimately deciding what the remedy is going to be, what the measures at the end of the investigation could be, are really unknown. One could imagine this thing resulting in a massive set of import restrictions. Now, why this is important is perhaps ironically, if the administration were to decide to say, let's just impose a across-the-board import tariff of 25% on imports of steel. Well, the main impact of that import restriction is not actually likely to be China. China is already sitting under lots of anti-dumping, countervailing duty orders in the United States. Most of the steel that we import in the United States is not coming in from China. It's coming in from Canada and Mexico and Japan and Korea and Germany. Right? So an across-the-board import restriction, if that's the decision under this Section 232 case, would actually likely have very little impact on China, at least imports from China, and actually target a lot of our trading partners. And that's the sense in which this could spill over, right? This friction between the United States and China, which is affecting other countries as well, could spill over and potentially get out of control. Now, in addition to the triggering of the national security law, we've also seen a couple of new trade policy cases under the global safeguard, the Section 201 law, one on solar cells, and then one last week on washing machines. And so this is really a potentially quite new era that the Trump administration is introducing. Now, to conclude, and just as a teaser, I'm showing you data here in this piece only through 2015. We're just rolling out, and we should have available over the next week or so, a whole lot of new data for what's been happening in 2016 and starting to look at the sizes of these, potential trade coverage of these types of import restrictions that we're seeing already in 2017. So check back into the PIIE website over the next few days, and we'll have that available for you. Thanks.
Now for an adjustment of the mics. It's always nice following Chad. The topic of Asia-Pacific regionalism has been under study at the Institute for a long time. And we've done a lot of work, basically with the underlying assumption that the force of progress in this area would be driven by the Trans-Pacific Partnership. And that has underlaid a lot of the work that we have done here at the Institute over the past 5 or 6 years. So in the immortal words of our Energy Secretary, oops, what is Asia-Pacific regionalism after TPP? And we've started work on this, and I want to thank my colleague Lucy Liu, who's the co-author and major contributor to this study. What we're seeing since the decision by President Trump to withdraw the U.S. signature from the TPP last January is the rise and fall, and perhaps the rise again, of Asia-Pacific regionalism. While the U.S. is out and will undoubtedly stay out of the TPP for the immediate future, the U.S. Action has had key implications for regional trade relations. First, there's been a radical shift in U.S. policy towards bilateral pacts, starting with negotiations with Canada and Mexico to modernize NAFTA. And those negotiations are likely to start in August, and we're going to have a big discussion of that here at the Institute next week. But also targeted are other important trading partners in the Asia-Pacific region, including Japan and South Korea. The decision has been a substantial setback to progress towards a free trade area of the Asia-Pacific, which has been a primary objective of members of the APEC, the Asia-Pacific Economic Cooperation Forum, and has been a primary objective of China as well since its leadership of APEC a few years ago. So this has all been bad news, but interestingly, many countries have not just given up and said, well, the U.S. is out, it's all over. Many people in Washington have said that, but that's not been the reaction in the region. And the U.S. action has refocused attention of other Asia-Pacific countries on how much was achieved in the TPP talks and the benefits that would accrue to each country from implementing TPP-style reforms. Now, what we have seen is a coordination of action among the TPP 11. The TPP had 12 signatories. Without the U.S., we're down to 11. But the response has been to continue to implement the TPP in some countries. Japan and New Zealand have already finished their ratification process after the U.S. withdrawal. To pursue new or deeper trade ties with China, because almost all the TPP countries had very substantial trade and investment relations with China before the TPP. To launch a new regional dialogue, trying to look at options for going forward, including the United States and China in that dialogue, and to keep options open for new negotiations on a comprehensive and revised Asia-Pacific Pact. This started in Chile last March, and most recently there was a very successful meeting of TPP 11 trade ministers on the sidelines of the APEC trade ministers meeting in Hanoi. There the TPP 11 ministers agreed to develop options to bring the pact into force, to bring the TPP into force, expeditiously and to include other economies that can accept the high standards of the TPP. A few months ago in this room, I presented a paper on going forward with Asia-Pacific regionalism and suggested that bigger is better, more content and more countries. And that message seems to have taken root among the TPP 11, because they're looking forward to revising the pact, upgrading it, and perhaps including additional countries going forward. And then the question is, how do you proceed on that? At least there is a process of discussing elements of putting a comprehensive Asia-Pacific pact into effect in the coming years. Now, as I said, the United States is not going to be a party to this. Ambassador Lighthizer has said very clearly the next steps for the United States are bilateral and seeking new or revised bilateral pacts. It will be hard for U.S. officials to achieve results in bilateral agreements as comprehensive as the TPP. And indeed will be hard to achieve any agreement at all bilaterally with many of the countries that meets the requirements of Trade Promotion Authority. Few are likely to bear fruit. Our new officials will learn by experience, and I'm afraid there will be a lot of wasted effort. But there is still the underlying need in the United States to have deeper trade and investment ties with our Asia-Pacific partners. There is already pressure from many members of Congress and from the business community and from the agricultural community who want a TPP-style deal and want to achieve the benefits that would have accrued from TPP liberalization of other markets, because actually the TPP didn't do much to change U.S. Access to the U.S. market. There are concerns that U.S. competitiveness will be adversely affected as U.S. industries face discrimination from deals excluding the United States. And countries in the Asia-Pacific continue to expand their trade ties with each other, and those agreements discriminate against the U.S. The beef producers in the United States already recognize this because they're being hurt already by the Australia-Japan free trade agreement. That puts them at a competitive disadvantage. And of course, there will continue to be pressure to reinforce U.S. strategic interests in the region, particularly urgent given the provocations by North Korea. This also has implications for the free trade area of the Asia-Pacific. And here, very briefly, it's a debate that's been going on in APEC for more than a decade. But most recently, APEC leaders agreed that a free trade area of the Asia-Pacific should be high quality and comprehensive, address next generation trade and investment issues, and build on ongoing regional undertakings. Sounds like the pathway to an FTAP should be TPP. That's what we all thought. And indeed, that is the only viable pathway that exists right now. The only other major mega-regional in the region is the Regional Comprehensive Economic Partnership among 10 ASEAN countries and 6 FTA partners, including China. But the TPP met the APEC test. The RCEP does not, because of the irregularity of its reforms, the scope of exceptions that are quite extensive, and other aspects that, if we had more time, I could go into. The point is that RCEP is complementary but not comparable to the TPP. It's very good for the countries involved in terms of marginal and incremental economic reforms that will benefit their development, but it does not provide a basis or a framework for a broader Asia-Pacific economic integration arrangement. A restructured Asia-Pacific deal along the lines of TPP would, and that's why it's in the interest of China to participate in both the RCEP and in the broad new Asia-Pacific dialogue that has been underway since the beginning of this year. China is an active participant in regional initiatives. It benefits from being pushed to pursue broader economic reforms. Many of the reforms in TPP complement those that have been aspired to by the Chinese leadership, though their execution has been flagging in recent years. And China already has an extensive network of trade and investment relationships with the TPP countries. I should say, though, that China is not yet ready for a TPP-style accord, but has been and should continue to work through its bilateral and regional arrangements to try to narrow that gap. So this table just shows you how extensive the trade and investment relations are with China and its neighbors. It has deals with almost everyone in the region, and it has investment deals with almost everyone in the region. If this will work. Oops. Which is important as well. These investment arrangements have been growing in sophistication from one generation to another, and the most recent deals are not up to the standards of the investment obligations of the TPP, but they are a big improvement over what has been done in the past and begin to provide a basic framework for investment rights and obligations in China. Now, the last slide is why Asia-Pacific integration is important for China. It's important as it upgrades, strengthens and upgrades its existing FTAs. It is in the process of doing that with current partners where the old agreements were substandard and are now being improved. It's developing new agreements with countries like Canada, where there's a feasibility study for a new free trade agreement, and it is developing higher standards of investment provisions. Again, this is the attempt to narrow the gap between Chinese practice and international best practice. It's important for Chinese economic reform and to give it a push and an incentive to do more. And most importantly, it's important for U.S.-China bilateral trade and investment relations. Because if you think about what we can do together, it's probably much easier to use a regional platform to develop U.S.-China common liberalization agreements, regional initiatives to provide a more politically viable platform for U.S.-China bilateral economic relations that may ultimately lead to an FTAP that includes both economies. Thank you very much.
Thank you, Jeff, and thank you all our speakers. Just to remind again, the full report, U.S.-China Cooperation in a Changing Global Economy, is available on our website. Essentially the same report, minus a couple papers, but with the advantage of Chinese translation or Chinese original, is available on the CF40 website as well. We've covered a lot of ground. It doesn't all come together in one neat package. I'm grateful to my colleagues, all four of them, for being forthright, each in their own way, of talking about where it's in China's interest to change and where, as particularly noted in Chad's comments, but throughout, the U.S. government is going down the wrong road. We, again, are trying to keep the focus on what are the things that are worth doing together in U.S.-China economic cooperation and how those can best be pursued. I'm going to open it up for questions from our distinguished audience. We have a roving mic in front with Jessica. There is a standing mic in back for those of you who it's easier to get to that. When recognized, please state your name and affiliation and ask a question, please.
Hi, I'm Chen Weihua, China Daily. Seems to, economists disagree. I mean, Dr. Ha said he would prefer the Chinese government does not intervene. 10 years ago, the currency, when it is strong, is going to appreciate and should not intervene now as depreciate. So others seem to suggest that it's a good thing Chinese government intervene, including Secretary Mnuchin 2 days ago. And it's great news. I mean, Chinese is helping U.S. advantage to intervene, to keep it sort of weak. So is that does that mean that intervene and manipulate to the U.S. advantage is a good thing, and otherwise it's not? So, but other countries who don't trade with China very much would say, hey, we like to keep it low because our people could travel to China cheaply. Thank you.
It's a fair question. Let me ask Jinming and Joe to each respond, please.
Okay. I'm thinking of this issue from the overall balance payment perspective. Because, yeah, China does enjoy still quite sizable current account surplus, though on the decline in percent of GDP. China's capital account is now experiencing quite significant capital outflow pressures. So, we need to make both a short-term and long-term judgment on the viability of the capital control measures. In the short run, yes, capital control could play a role deterring disorderly capital outflows. Then the renminbi could face appreciation pressure given the sizable current account surplus. But from a longer-term perspective, I don't think we have a contradiction in our views. It's, it depends on whether you look at the issue from a long-term or short-term. In a longer-term perspective, I don't think capital control should be put in place forever, right? And it actually distort resource allocation. So China should press ahead with other areas of reform to pace the way for capital account liberalization going forward. And this is actually enshrined in PBOC's policy and also enshrined in the Communist Party's 18th Congress. Let the market play a decisive role. Thank you.
Well, I think the U.S. government a few years ago asked China to just freely float, which would seem to imply no intervention at all, which is what Dr. Ha said his goal was, and I've heard some people in China say that too. I come from a slightly different perspective. It seems to me that financial markets do often get things wrong, and they pile in too far in one direction, and they rush out in the next few years. And I think it would be good to put some sort of buffers or dampers on that. And I would be symmetric, and I would have every country do it. And I think, in my view, China is doing exactly the right thing now. Maybe not for exactly the right reasons I would have, but I do think if you imagine a huge outflow of private capital from China that caused a massive fall in the renminbi and a massive trade surplus again, I think the rest of the world, especially now, would have trouble with that. I think it's better to try to keep these things from getting out of control.
Let me add an editorial note. I mean, I think our questioner is right to point out the way a lot of U.S. policy becomes hypocritical or can be viewed as hypocritical on this point, and I'd just make two notes. First, as in Fred and Joe's book, the key thing is you can objectively or at least reproducibly come up with criteria that it's not whenever the dollar weakens it's good, it's when you're intervening when you already have a very large trade surplus and you're intervening in the direction of further pushing that surplus. This is the kind of thing Jinming was talking about when he referred to China not being a currency manipulator, and that Secretary Mnuchin spoke about earlier. There are genuine criteria, which Joe and Fred advocated and which seem to have been adopted by the Treasury. Now, but the second thing is we have to admit the U.S. government, frankly, screwed up. The U.S. Treasury screwed up for a long period in the 2000s. A number of us in this institute, including myself and Fred and Morris Goldstein and Nick Lardy at the time, were very critical of the U.S. Treasury's unwillingness to confront China more forcefully on currency manipulation. And frankly, the U.S. Treasury made it worse by saying these stupid things about we want a market-determined exchange rate. And for the reasons Joe said, and the huge distortions in China's savings behavior, meaning that everyone, if you were given free capital movement, would want to diversify out of China for an extended period, this was a stupid policy. And when you talk to people who were senior in the Treasury in those days, they say, well, the State Department or the White House told us we couldn't really call him a manipulator, so we said, please have a market-determined policy. But of course, that was garbage. You didn't want a market-determined policy. You wanted a non-manipulated policy and a currency that was not out of whack. And a market-determined policy would lead to the kind of mess we had 18 months to 2 years ago in the second half of 2015 in China. So the U.S. deserves, the U.S. government and the people who were officials in that period, both Bush and Obama, deserve some criticism for their hypocrisy and for their mishandling of it. But that doesn't change the underlying issue that Jiming and Joe raise, which is that it's in China's own interest as well as the world's to have a relatively stable currency, and that the imbalances should not be allowed to get way out of whack. Please, at the back, Mike, and then at this table.
Thanks. Kim Elliott, CGD, and I had a question for Chad. You were making me feel old, Chad, because what you were describing as the new Trump trade policy sounds a lot like what we went through in the late 1970s and 1980s. And so I'm just wondering what is new is the World Trade Organization, and what could be new in the Trump trade policies that they just ignore that. So that's what I'm wondering is what you think the prospects are for the WTO playing any role in constraining this new old trade policy.
So I think that's a great question, and it fuels one of my underlying worries because I think with if they were using simply the policy tools that everybody uses, anti-dumping, CVD, even the Section 201 global safeguard, then we know how this plays out. Trading partners challenge you at the WTO, maybe you win, maybe you lose. Worst case, you remove after a couple of years, fine. With these national security cases, this is a lot harder. It's not clear what's a justifiable national security case at the WTO. And you're really worried about bringing challenges because, suppose you bring a challenge and you win. Then what it is that's happening is you have, judges in Geneva telling the Trump administration you can't do things to protect what you perceive to be in the U.S. national security. And that to me seems like it is just offering them a get out of jail free card to get out of the WTO, to say, well, if you're not going to protect or respect our sovereign right to protect our national security, we don't want any part of this organization. So to me, that's what my real worry is that by triggering that sort of law, it really has the potential to undermine the system and have things, I think, spiral out of control. And, this is one of the reasons I think why countries have the United States in previous administrations has chosen not to go down this path and use this law, even though it was there, and other countries haven't as well. You don't want to see where it ultimately will lead you.
Great, Chad. You've now made me feel old and depressed. The two gentlemen on the opposite sides of the middle table. First there, please.
Okay, thank you, Ms. Paulson. I'm Zhu Hong, the Commercial Office, Chinese Embassy. Now, the Trump administration's big concern on trade policy is imbalance, trade deficit. But this report rightly points out that although balance, the two-way trade is, there's no meaning on the industrial competitiveness or some of the families' income. But the new administration is still very concerned over the trade deficit. So China just recently released a new report 2 weeks ago regarding the economic and trade relationship between China and the US. And it also rightly points out that actually the trade imbalance is a reflection of the United States over-consume something. And it is according to
I'm sorry,
academic
Minister,
research.
do you have a question?
Yeah, okay. My question is two. Academically, what is the proper level for the U.S. side to keep what level of imbalance is best suitable for the United States? And practically, my second question is how can you convince the U.S. official to let them to understand this situation? Thank you.
Thank you. Would anyone care to comment? Joe?
Well, yeah. So, first of all, in our book, Fred and I say that we think bilateral balances are meaningless and really worse than meaningless. They take your eye off the ball of what matters. It's the overall balance of a country that matters. And to the extent that China's behavior has any effect on the U.S., it's China's overall behavior that matters. We have set out criterion where balances in excess of 3% of GDP, intervention in excess of 2% of GDP, that the Treasury, the U.S. Treasury, has adopted as well. And those could be discussed in international fora, but we think that that's the right idea. Some kind of quantitative agreed limit beyond which we think things are excessive. I think the one thing we disagree with the Congress and the Treasury on is the bilateral component, and I think you probably would agree with that.
Let me go one step further. You quite reasonably framed it as sort of the academic, what's optimal, and then the practical. Joe and Fred are very clear about this in their book, and this has been true throughout Institute research on this issue. There isn't an academic optimal number for the U.S. or for any economy, and you could make a set of reasonable statements about countries with large reserve positions can afford to run much bigger deficits, or countries that are importing a lot of capital because they're developing, or like Australia, can run bigger deficits, and other countries cannot. But repeatedly, scholars in the policy field, including Joe and Fred, have said, well, let's pick an arbitrary but reasonable number, because you don't want to have somebody, be it the IMF, be it certainly not the U.S. Treasury, making a ad hoc arbitrary decision case by case which country should have which size deficit. I know that's not what you're advocating, but I just want to be clear that coming up with like the 3% of GDP level, which is actually very commonly held to be a reasonable level for most countries, has a certain amount of arbitrariness to it, but it's the trade-off of the practical and the academic. And so that's why I'm not going to say we, but I think the majority of people writing, including Joe and Fred, come up with a number like that. In terms of convincing the current administration, I hope President Xi has another great summit with President Trump. Please, there and then at the back, Mike.
I don't think that would help, but Claude Barfield, the American Enterprise Institute. I'm older than Adam, but I'm not depressed at the moment.
Good.
As most of the people at Peterson know, I'm pretty much a unilateral disarmament on trade issues. But in terms of China and the U.S. high technology, information technology, and internet-related companies, I've gradually come to the position that I think the United States is going to have to introduce reciprocity issues in terms of investment. And I do that because there has been a systematic set of rules and regulation that both directly and indirectly are excluding not just U.S. but foreign corporations in these sectors. And the latest example, I think, you could take the Great Firewall, which on so-called moral or public order is really an industrial policy, has been used as an industrial policy tool. The recent cybersecurity law goes to the heart of a foreign company competing in the Chinese market. So my feeling is that, and I have great distrust, as do many in this room, about anything that the Trump administration will do on trade, but the United States, no matter who the president is, has got to move a position of, and I'm reluctant to do this, of some sort of reciprocity. If our firms are not going to be allowed to compete fairly in the Chinese market, then Chinese firms in the information technology and internet related sectors are going to be excluded from the U.S. market. Tell me where I'm wrong about that.
It's a great question, and this is a general question, not just in tech, but in steel, as Chad dealt with, in other fields. Or putting it differently, Claude, for you and me, and I won't say Kim, but some of us old folks, it's essentially another version of why is China different? When Hong Kong and Japan, excuse me, not Hong Kong, please forgive me, Korea and Japan, basically did that and said, we're not going to give you access to our market. It turned out in the not too long run to still be in the U.S. interest to pursue as it did, and it cost them a lot. But there are a lot of smart people, yourself included, who are now saying, but no, maybe it's different with China. So let me go down the row here, maybe skipping Joe, but going Jiming, Jeff, and Chad on this very important issue.
Yeah, I think it's a terrific question. That's why actually we pointed out in our report that there are certain industries, particularly service-related industries, where China still has a huge room for further opening up to the rest of the world, and also to domestic private investors. Telecom being one of the sectors, finance is another. As recently as last month, I was still with Goldman Sachs. We know that the situation in China, the financial sector, should be more open to foreign investment. Healthcare is another one. In China, there's a huge demand for high-quality financial services and healthcare services. But the thing is, the market is still quite closed to foreign investment. And these are the areas that we think could benefit China and foreign investors as well if there's a further opening up. And that is probably, not only in the summary part, but also in
your
many of the
essay,
chapters.
yes.
Yeah, we highlight that. Yeah.
Jeff?
Well, I basically agree with Claude. This is one of the reasons why China is still not a normal country in the trading sense. And a big reason why there is still a large gap between the positions between our two countries in trying to negotiate more open access for investment in our countries. There won't be a bilateral investment treaty while this type of action continues in China. That's clear. President Obama started a dialogue in September of 2015 with President Xi Jinping on this issue. But it's been mostly rhetoric because despite that start of a summit dialogue, there has been the continuation of this promulgation of the new national law in China that goes against the principles that were being sought in the bilateral dialogue. So I think that's very troublesome, and I think there's room to have a revival of that dialogue. I think the dialogue would have to be much more concrete, as you suggest, but that would be bringing back into question some of the more unfortunate provisions of the cyber law and seeking their revision.
Thank you. Chad?
I'll be very quick. So, Claude, I don't disagree with you in this example, I guess, but what I would be worried about is the Trump administration in their currently taking that reciprocity approach too far, in my view, where they're looking at it not just, thinking that we should have reciprocal rules and sectors, but within a sector, product by product, we should have the same tariffs on stuff coming in from you as you have on stuff coming in from us. And when you just think about how trade negotiations work and how you get deals done, that just it quickly unravels and doesn't make any sense, right? And so, while in this instance I don't find flaw with your logic, my concern is that it might be adopted wholesale and applied in areas where it really wouldn't make sense.
I'm going to actually push our colleagues on stage a little bit further, though. I mean, we have a very long tradition of liberal, in the Economist magazine sense, trade policies, which Claude, as he describes himself, a unilateral disarmament type, usually adheres to. And the argument usually is reciprocity is counterproductive, and it's not welfare enhancing. So what is different about either this industry or about China in the sense that Jeff said, well, it's not normal in trade terms? What is different about China as opposed to these kinds of disputes in the past with other countries that people who normally wouldn't say, I want no reciprocity type deals, do want reciprocity here?
Well, the first point is, in a sense, it's a type of method of expropriation of assets, whether it be data or information like. And second, it is an area where there is no international rule or guideline or benchmarks. So if there was an international agreement on what is the appropriate behavior, then it could be arrayed against that, and you could determine whether it was consistent or not, and if not consistent, you take appropriate retaliatory action. What Claude seems to be implying is there is no benchmark. It's sort of outside of the playing field, and so you can take a Section 301 retaliatory action without reference to the trading rules because it's outside the system. It seems to me that that there is some merit to that, but Chad's point is very important to keep in mind, that you can have the reaction get out of control and be excessive and diminish the possibility of getting back to a rules-based agreement that actually sets an appropriate benchmark that can guide the reform of the Chinese policy and that of other countries. So that's where I would come out.
Thank you.
I would just clarify a little bit. I'm actually a huge reciprocity guy. I just don't want it limited to product by product. We have to have the same thing. So what I would argue is, what I think is likely contributing to the impediment of the U.S. companies getting access to the Chinese market is we haven't found something of sufficient value to be able to offer the Chinese government in return in a sort of deal, and maybe it's because we don't have the right negotiating framework to get something done, that would allow them to, make the reforms to open up in the way that our companies would want. And so I think that there are reciprocal deals to be made. What I would say is, if we can, let's not limit it to being a cybersecurity deal or a, small car to small car tariffs deal, right? Let's open up the framework for where reciprocal deals could be made.
Jiming, do you want to add anything? No. Great. At the back mic, please, and then the lady here at this table.
Brian with China Xinhua News Agency. Jeffrey had just made a case of using a regional approach to deal with the U.S. and China trade and investment issues. But the Trump administration is focused on the bilateral approach. The two countries had agreed a 100-day action plan, maybe later a year plan, to address the trade and investment issue. What's your take on that? And by the way, how can we convince the administration that the regional approach is better than the bilateral approach? And do you think it's possible for the administration to get back to the regional approach in the next few years? Maybe they could modify the TPP and they can rejoin the agreement. Thank you.
Well, very, very briefly, there's no reason not to have a bilateral and a regional approach. That's what China is doing, and doing very effectively. It makes sense. And what I'm suggesting for China is it expands its regional horizon to the Asia-Pacific and tries to take domestic reforms that will narrow the gap between the Asia-Pacific standard and the Chinese standard. It's been doing that incrementally over the last couple of years. For the United States, I think they will find that they're not going to get as much as they hope for out of a bilateral negotiation, given the fact that the U.S. market is already open, and they're not willing to remove the remaining barriers to access to the U.S. market. In fact, there's been comment that they would claw back some of the liberalization that has already been on offer. When they have the experience of a number of bilateral initiatives, they may reevaluate their position on moving both bilaterally and regionally at the same time.
Okay. The lady here, please, and that'll be the last. Well, okay, we'll double up. Please. Go
Mine will be
ahead.
quick.
Hi, I'm Denise Carpenter with the Commerce Department. I would like to follow up on just Mr. Barfield's issue about that brought the comment, what is different with regard to Japan, for example, and China. I actually worked for Jetro back in the 80s when there was a very contentious trade situation going on with cars, machine tools. They bought Rockefeller Center. And I think at the time they were also writing white papers targeting particular industries, their industrial policy. Could the difference really be now with regard to China more in our uncomfortable? I think at the end we felt that Japan was always our friend, that they were a democracy, whereas now we've got a political system that isn't quite a match with our own. And I think money has a lot to do with it. We've got China borrowing from large, Chad Brown used to work for the World Bank, large institutions like the World Bank while they're funding their own development institutions. They have access to capital that US companies don't have access to. And as a result, even recently, US solar panel manufacturers are going out of business because the Chinese have been able to access a lot of money at the banks to develop their market while...
I'm sorry, could you...
So
come to
I'm
a
just
question?
wondering if you think that could be an issue in terms of what makes China and Japan different, the money, the access to money, and then also the political system that's otherwise they're both trade issues.
Right, and the key is not so much that there are individuals, including in the administration, who would say that it's different for those reasons. The question is, do you think it's justified to make that distinction? And I'd be very happy if Jiming chose to comment as well, but whoever would like to go first. Chad?
So I think that's the case, right? So China is very different from Japan and any other country out there in the world. Japan, even in the 1980s, we've heard already about the incomplete, transformation of the state-owned enterprises. But even the private sector has evolved in a way that involves state intervention and in ways that's different from how the United States and other market economies work. And so that's going to be an inherent point of conflict until we come up with trading rules that either explicitly allow for that and accommodate it, or China transforms. And right now, my concern is we're not talking about how we actually get to that end point. We're now just at the state of conflict where we don't have the right set of rules to accommodate it, and we don't have the right forums of negotiation to write those rules.
Okay, please, at the back, Mike.
A quick final question.
I'm sorry, could you identify
I'm sorry,
yourself?
Kathleen Hayes, Bloomberg TV and Radio. Hello. Lovely lunch, by the way. Recently having a conversation with colleagues about all these shifts spurred by Trump, et cetera. Mr. Hong, you mentioned U.S. consumers being very consumptive and how that contributes to imbalances. When you talk, though, about new trade groups without the United States, this colleague raised the point, the U.S. is probably the biggest consumer in the world. What are all these surplus nations going to do without a deficit nation in their trading group? And I want whoever wants to comment on that, what that means in terms of how these things actually progress without the United States involved.
Yeah, let me probably
please.
take this question. I think, as I alluded to earlier, China is a country with a very high savings rate, with a household savings rate being as high as around 25%, national saving 45%. In order to avoid being a surplus country, you need to invest 45% of your GDP per year into the economy. And that will be too much. That is either not only impossible, but also probably undesirable. One of the biggest issues in China's economy is now overcapacity, which stems from overinvestment, be it in the steel sector, alumina, and probably some infrastructure development in China has already sort of reached a certain limit. So the key here is, of course, ultimately you need to promote consumption growth, but that's not something you can achieve overnight, right? Things need to be done in order to promote consumption growth, and this is actually happening in China. Minimum wage, which is controversial, but it served China's consumption growth. And also the abolishment of one-child policy sort of encouraged family to consume instead of to save. And I would point out that looking forward, it is very important to keep in mind that China's savings rate will have to fall, because the Chinese baby boomers, those who were born in the 50s through 70s, are retiring. They are in their mid-60s. The first cohort is already in their mid-60s. And going forward, a lot of them are going to retire. You have a high dependency ratio in China, which will definitely driving down savings rate. So I think at this moment, we need to be very careful. There are already natural forces that will drive down China's savings rate, reducing China's current account surplus. If at the same time we use too much policy to accelerate that process, that could, lead to a new kind of distortion. Just as what we observed 10 years ago when China's demographic dividends were being unleashed, current account surplus was huge, and at that time the exchange rate didn't adjust. I think the point I would try to make here is we need to avoid, excessive policies that will add to a unnecessarily fast adjustment of the Chinese economy. And we need to respect the market forces. That is something we didn't do well in the past, and it is a time we should correct it.
If I can just close this out, Kathleen. I mean, you're absolutely right to raise this, but let me remind you of two things. First, very much parallel to the discussion Jiming just gave us about Chinese savings, I'm sure you saw our PIIE colleague Jason Furman's op-ed in the Wall Street Journal talking about, yes, Germany's imbalance is consistent with what Joe was saying, maybe a problem, but trade deals, whether that's within EU or TPP or whatever it is, are not the source of these. And so everyone talks that way. The Trump administration particularly talks that way, that trade barriers or trade deals are determinant current account imbalances, and they're not. And the second point, which actually is even more overlooked but is more important, has been made by a number of us, including colleagues like Carolyn Freund and Gary Huffbauer here, is that there's actually no correlation between doing really well, quote unquote, and running a very large trade surplus and doing really well economically, except at very low levels of development. And so, everybody now says, oh, we all wish we were Germany. Well, there was a good 15, 20-year period when no one wanted to be Germany. Everyone used to say, oh, Japan's cheating and benefiting. Well, there's now been a 20-year period when no one wants to be Japan. And so for all the reasons about destabilization over time that Jiming and Joe in particular spoke about, I know you know this, but just let's get it on the record. It may well be, you're absolutely right, countries will say, well, how can I have a trade deal that doesn't have an obvious consumer of last resort like the US, doesn't have a big market opening? That is what trade negotiators say, but for the citizens of the countries they're supposed to represent, what matters is the expansion of variety, the increase in competitive pressure on your own economy, the importation of greater, cheaper goods for your people and services, the productivity gains of trade is ultimately why you do it, and not because you're trying to find someone to ship your stuff to. And this ultimately is why, as we've researched, China may have many good reasons for doing the Belt Road Initiative, but the idea that it's going to be the place where they ship all the stuff they've got excess in China is not going to pay off. Anyway, I want to offer my thanks to all our colleagues who contributed to this briefing. Again, it's all available on the PIIE and the CF40 websites. You can download individual papers of the whole thing. I'm very grateful to CF40, China Finance 40 Forum, our preferred partners in China who continue to set a course for independent thought and economic analysis there, as exemplified by our colleague Jiming Ha today. And I thank Joe, Jeff, and Chad as well. This meeting is adjourned.